What is starting now is what we call the earnings season. Basically, every quarter companies release how much money they earned during the last quarter, how much revenue they earn, and because of that, there's going to be a lot of volatility happening on those stocks. And because of those earnings, because companies release how much revenue they earn, that creates a lot of speculation, which means that for option traders, this is the moment where there is a lot of volatility and so a lot of money to be made. And in this video, I wanted to share with you how I trade earnings, do a small recap of my strategy, what are the things that I pay attention to, and also show you some results of some trades that I've taken today and yesterday, so you can see what you can expect when trading earnings using the strategy that I use. So I know that I've already made a video on the subject like several months ago, but I wanted to do an updated one so you can see more results, and it's a bit of a refresh so we can start this earnings season on the right foot. But before diving into the video, if you have any question at any point of the video, just don't hesitate to comment it below. I'll be happy to answer any question that you might have. So first of all, let's do a small recap and let's just, recap what are earnings and what are those announcements that you see everywhere during this, what we call earnings season. So as I said, every quarter publicly traded companies are going to say, all right, we earn XYZ revenue, and analysts and a lot of people are basically trying to predict what are going to be those numbers. And I'm sure that you must have heard about something, for example, that is called the earning per share. The earning per share is a very common metric that analysts try to forecast when they are trying to say, all right, for example, Apple will have an earning per share of, let's say, $2.15 for Q3. That's basically what analysts are going to do. After that, analysts are not going to necessarily be the subject here, but that was just to show you what you can do when we talk about earnings. For us option traders, what brings those earnings is a lot of volatility on the stock. And what does that mean, having a lot of volatility on the stock? It means that a lot of people are going to bet that the stock is going to go up because they're going to have great earnings or bad earnings. Basically, people are buying and selling options so as to speculate on the stock direction. And that creates a lot of volatility in the option price movements. And because there's a lot of volatility, there's going to be a lot of variations in the option prices, creating a lot of opportunities for us option traders. Okay, so that was basically for the recap. That was a very simple and quick recap about what earnings are. And if you want more information, just type, what are earnings on Google and you'll see plenty of resources. I just wanted to do a small recap so you have some context. And now let's go directly into the strategy and how you can take advantage of earnings. So as I said, when earnings are happening, that is going to create a lot of volatility. That is going to create a lot of speculation, and you're going to see option prices moving a lot. And there's a very particular tendency in option prices when it comes to earnings. Very often, almost I'd say 90% of the time, you're going to see option prices prior to the earning announcement, because there is always a date when the earnings are being released. That's why we call that earning announcement. For example, there is going to be a date like, 2nd of October. Well, 2nd of October will be the date of the earning announcement. And up to the date of the earning announcement, we're going to see a phenomenon that happens almost all the time. Option prices are going to get more and more expensive up to the earning announcement date, and then right after we're going to see something that we call IV crush. I'm sure that you already heard about IV crush. That's a term that is very often used in the option trading community so as to refer basically to the implied volatility crush, a sudden drop in the implied volatility. And what does that mean, a sudden drop in the implied volatility? Well, it means that basically if you have a sudden drop in the implied volatility, it means that option prices fell very quickly. If the option prices get more expensive, then the IV goes up, and then if option prices get cheaper, then the IV goes down. And that's on that phenomenon that the whole strategy, that the whole playing earnings can actually happen. It's because we have that predictability of having the option prices getting more and more expensive up to the earning announcement, and so you have the implied volatility. You can see the implied volatility rising up to the earning announcement date, and then right after the earnings are announced, then you're going to see option pricing dropping like almost suddenly right after the market opening, which means that you're going to see the implied volatility crushing. That's why we call that IV crush, because option prices drop suddenly. And let me show you some examples on Tastyworks so you can have a visual example. Okay, so now we are on the Thinkorswim platform and I'm going to show you some examples of IV crush, and the first one is going to be on Zoom. So what you have in front of you is the stock price for Zoom, okay, so for the moment it's clear. Then below you see that you have something called imp volatility. So that's for implied volatility, and that basically tracks the implied volatility for the Zoom over since the last year. And I wanted to look exactly at when happens earnings so as to see how the implied volatility behaves. And remember one thing, when you see the implied volatility rising, it means that option prices are getting more expensive. And when you see implied volatility falling down, it means that option prices are getting cheaper. So if we look at, for example, when they are, you see all of those red bubbles and blue bubbles, and there are some numbers also, $1.22, $0.99, $0.92. Basically that represents when earnings are happening. And what's going to be interesting is to look at when earnings are happening, how does the implied volatility behave? Well, what we're going to see, if we look at, for example, the same day where there has been the earning announcement, I've put it in the red rectangle so you can see it more clearly. Well, you can see that there is this implied volatility that is going down. You can see that it's actually falling the day of the earning announcement. And you could tell me, all right, maybe it's just, one time, once the implied volatility is going down, it's not happening all the time. Well, if we look at the other times, basically every time there is an earning announcement, you're going to see the implied volatility dropping after the earning announcement. And that's very common. And the reason why the implied volatility is moving so much, and the reason why option prices are so volatile during earnings, is that basically people are speculating on that. People are buying calls, they're buying puts so as to express their views on the stock prior to the earning announcement, pushing option prices higher, and right after the earning announcement, well, there's no point in buying a put or a call anymore because the earning announcement just happened yesterday, for example. So what's the point of buying an option? Hence why the option prices are dropping now, because there's just less interest in the stock, and now the earning announcement has passed, so there is no reason to buy a put or a call so as to, try to take advantage of the stock. And as the earnings are attracting so much volatility, so many people willing to take bets on them, once it's gone, the option prices are just falling off the cliff. And that's something that you can see over and over again. And here we're just looking at Zoom. You see that right now I'm also putting in rectangle, like a moment where the earning announcement happened and then the IV drops right after. But you'd probably tell me, it only happens when it comes to, for example, Zoom, like that IV crush doesn't happen for the stocks. Well, I can tell you that it happens most of the time. And for example, let's say that we take Apple. Apple is a very famous stock, and maybe you could think that this is not really happening for such big stocks like Apple. Well, I can tell you that it does. If we once again put the same date and we look at the implied volatility, you see that it's coming down on the same day of the earning announcement. Once again, if we look at the previous one, you see the implied volatility dropping, or once again here you can see that it's dropping after. It's basically always dropping after the earning announcement. And even if it doesn't come right away, I mean, it is going to come, let's say during the day or maybe the day after, but there is always this IV crush that is going to happen, or let's say almost. So you tell me now, all right, cool, so I understand the concept of IV crush. I understand that when option prices are getting more expensive, then the IV increases, and vice versa. If the option prices are getting cheaper, then the IV is going to drop. But how does that help us, and how can we take advantage of that? Well, there is a way I personally trade earnings, and that's something that I do all of the time. I do every quarter the same strategy on the same stocks, and I do that over and over, and I'll show you some results after so you can see what to expect. What I'm basically doing is that I'm going to sell options the day before the earning announcement, when technically option prices are their highest, where they are the most expensive because the IV is at its highest, and then I'm going to hopefully buy back my options at a cheaper price the day after the earning announcement, once the IV crush happened. And the goal of that strategy of selling options the day prior to the earning announcement and then buying them back the day after the earning announcement, the purpose of that strategy is to catch this IV crush, is to catch that IV crush and catching that fall in the option prices, because we know that that pattern happens very, very often. And honestly, I can say that it happens almost 90% of the time, if not more, honestly. I don't have proper data on this, but I can be almost sure that it happens more than 90% of the time. Because you know this, because you know that that pattern is pretty reliable, then we can build a strategy around it that is going to allow us to benefit from that IV crush. And that's what I wanted to show you in this video. And finally, we're coming to the strategy, but I needed to explain some context. Please forgive me. So as I said, my strategy consists in selling options the day before and buying them back the day after. But how do I do this exactly? Well, I'm going to use a strategy that is called short strangle. A short strangle consists in selling a call and selling a put at the same time, and by doing this, you're essentially betting that the stock price is staying within the range. And if the stock stays within that range, then, well, with the IV crush, you're going to make a profit like almost instantly once the market opens. And that's the very nice thing about that strategy, and that personally blew me away when I started getting into options, is that you don't need to bet that the stock is going to go up or down. You can bet that the stock is going to stay within a range, and that range you choose it. I'm going to show you after that in SCHW how you can build this short strangle, but this is just to give you high level view of what is the short strangle. And as you're selling options, when you're selling a short strangle, you sell a call and a put. Well, as you're selling option, well, you want the option prices to decrease because you short the options, so you want to buy them back at a cheaper price so as to make a profit. And so because you short the option, if this IV crush happens, meaning that the option prices are getting cheaper, then it's great for you, because as you want the option prices to get cheaper, that IV crush is exactly doing this for you. Hence why I like to sell it the day before the earning announcement, so I'm selling the option basically at the highest price possible, and then with this IV crush is pulling the option prices down and basically doing the work that I wanted to do. It's exactly going to make the option prices cheaper, making me money at the same time. So let's jump into SCHW so I can show you actually how does that look in terms of building that short strangle within the platform. So right now we are in the SCHW platform, and I've chosen the stock SCHW, and I'm basically going to put a trade right now within the video. But it's not live because you're watching that video, but you get my point. I'm going to set up the trade and try to fill it right now so you can see exactly how I do it. Okay, so we know that we want to use that short strangle strategy, but even before talking about calls and puts, we need to talk about strikes, and we need to understand what is going to be the expiration that we're going to use and how does that work. Well, the first thing that you need to think about when you're thinking about that strategy is to think about the expiration. Which expiration are we going to choose? Because you see that there are actually quite a lot of expirations, so which one should we choose when we are trying to trade earnings? Well, personally, I like to go for the closest expiration. Why? Well, because as the earnings are happening, let's say in the case of SCHW, they are happening tomorrow. Then I want to trade the options that are going to be the most influenced by those earning announcements. So I want to choose the option that is expiring right after the earning announcement so I can benefit as much as I can from that IV crush. And if we look at, for example, all the expirations that we have in front of us for SCHW, we see that we have that July 16 expiration expiring in 1 day. Well, that's exactly the expiration that I'm going to go for. I'm going to go for the closest expiration so as to benefit the most from the IV crush tomorrow. And something to notice here is that on the right, you can see that there is the IVX, that's IV index, that's basically the IV. What you can see is that you have the IV for all of the expirations. What you notice directly is that the expiration the closest, meaning the one that is expiring on July 16, it has an IV of 55%, when the one that is expiring in a week only has an IV of 36%, which shows you that all of the implied volatility is concentrated within that expiration where there is the earning announcement. And that makes sense. Why would there be a lot of people speculating for an event that is happening this week, but they're going to trade the expiration from next week? That doesn't make sense. Hence why there is all of the volatility within that earning week, and that's why I'm also going for that one. I hope that makes sense. So we solved the expiration question. So let's go within the July 16 expiration. So as I said, SCHW's earnings are happening tomorrow, to July 16, before market opening. So it's exactly going to be in the right time frame. So now the question is that you see that we have all of the option chain in front of us now that we have chosen that expiration. We have calls and puts. So how do we build a short strangle? Well, to build a short strangle, as I said, you need to sell a call and a put. And to do that, you could basically choose any strike that you want. You could sell, for example, the 24 delta put, which as you can see, the deltas are in this column. And remember that the deltas is basically a quick way of referencing, which strike we're talking about. If you talk about the 30 delta, then it means that that option at that 30 delta has roughly 30% probability of expiring in the money at expiration. And so 70% probability of expiring at the money. And that's how I use deltas personally. I'm going to use it as a way to quickly know how many probability of profits I'm going to have on that trade. So in that case, it would mean that I have around 24% probability of expiring in the money, so 76% probability of expiring out the money, which is pretty fair to me. But as I said, to build a short strangle, you need to sell a put and you need to sell a call. So we're going to go on the other side, and let's say that I sell the same call at the 24 delta, and that's going to basically bring me 67 cents of credit in total. And if we look at how it looks from a P&L perspective, well, you are going to very often see that graph. And that graph basically shows you the P&L at expiration. So if the stock expires at expiration, so tomorrow night, between like 73.12 and 68.30, then I'm going to make money at expiration. If it expires out of that profit zone, then I'm going to make a loss. So as you can see, we find that I'm betting that the stock is staying within a range, because that's basically the range that I was talking about. That's the range that you want the stock to stay in. And if it stays in, then great, you're making money. If it stays out, you're going to have a loss, and I'm going to explain how I manage losses right after. So that's basically it. That's basically the short strangle. You sell a call and a put, and as I said, I'm going to sell that short strangle the day before the earning announcement, and then I'm going to hopefully close it for a profit the day after the earning announcement. So you would tell me, right, okay, so is that simple? You just, like sell short strangles one after the other and just make money like this at each and every single earning? No, that doesn't exactly work like this. I'm going to explain why, and also, explain you some tips and tricks that I've learned, because it caused me to lose money when I didn't do them, and now I do them and I don't lose money anymore. So I'm going to explain them to you, so it totally makes sense. So you have all the technicalities. Now you understand how the short strangle works, you understand what is that strategy, you sell a short strangle, but how does that work in terms of profit and losses? Well, for the profit, it's quite simple. Once the day is passed, and let's say I see that my strangle is in a profit, well, I'm just going to take the profit as it is. I'm not going to wait, like 1 hour, 2 hours, 3 hours just to see where the trade is going. Directly when the market opens, if it's in profit, I take my profit regardless of how much profit I have. Usually what I'm going to see is that I'm going to usually collect a profit of around 60%, 70%. That's something that comes back quite often, meaning that if, for example, let's say you sell a short strangle bringing you a credit of $1, meaning that you could make $100 max profit, well, usually I'm going to make $70 profit out of those 100. That's usually what I'm seeing. And in terms of losses, well, there are several ways you could manage losses when you're using a short strangle. You could just take your loss, just close your position, and that's over. Right after the earning announcement, if you see that your trade went into a loss, you could just take your loss and move on. Or you could roll your trade. And by rolling your trades, that basically allows you to buy yourself more time to be right. And I won't go into too much details into how I roll losing trade, because this is a video by itself, and I've already made some videos on the subjects, and you must see now the thumbnail of that video, and I'll put the link into the description of that video if you want to see how I roll losing trade. But basically, you could whether take the loss or roll your trade. And personally, the philosophy that I'm really having about earnings, and that's something that I really want to emphasize here, I usually just take my loss if I'm in a loss directly after the earning announcement. I don't even try to roll it. And here's the reason why. When I'm trading earnings, you have to see this as a binary, in a way, event. Either you win, either you lose, but I don't like to treat this type of earning trades as, let's say, trades that I'm going to roll after and try to save for 6 months and everything. If I'm in a loss, I'm just taking my loss and moving on. And same for the profit, by the way. But I'm really not sticking with those trades. And the reason is that, first of all, it's undefined risk, meaning that, as you see, when you're selling a put and a call, like, your loss is theoretically undefined. So when I'm selling options and I have like an undefined risk, for example, in the case of a short strangle, I'm really not there to, wait around and just be exposed like this on the market. I'm going to be there, less than a day, because I'm going to be there during the earning announcement, and then I'm out. And if I can be out ASAP, I'm going to do it. Hence why I don't usually roll trades when I'm selling short strangles for earnings. I'm going to usually either take the profit, take the loss, but I'm going to not roll the trade, because I just don't want to have that trade on for a very long time in my portfolio. But that's only my opinion. If you want to roll your trade, that's absolutely doable. Now, something that is very, very, very important to do, and honestly, when I did this, that changed that strategy from honestly being a losing strategy to a winning strategy. And let me explain you that thing because this is so important. All the stocks, and I'm putting that mic closer, all the stocks are not created equal. What I mean by this is that some stocks are going to be usually more volatile during earnings compared to some others. And I was talking, for example, about Zoom earlier. Zoom is a stock that usually moves like crazy, you know, that stocks is like insane during earnings, and that's how it is. Usually that stocks is going to move a lot compared to, if you look at, for example, bank stocks usually don't move that much during earnings, which make them a lot better candidates for selling short strangles, because as you're selling a short strangle, you're betting that the stock is staying within a range, so you might as well sell a short strangle on a stock that usually doesn't move too much during earnings. That makes sense, right? So that tip is basically focusing on stocks that usually don't move too much during earnings. So now you would probably ask me, okay, cool, but how do I know if a stock usually doesn't move too much during earnings? Is there a way to know this? Well, there is. There is a website where you can basically check the past history for earnings for a particular stock. And that website is called OptionSlam. So I'll put the link in the description of that video if you want to check it out. That's honestly like an amazing website. It's free. I mean, you can pay, but you don't need to pay. I use the free version and that's already enough. So really, I don't see why you want to pay. But basically, that website is looking at what happened in terms of earnings for a stock in particular, and it's going to rank it so as to let you know if it's usually a volatile stock or a low volatile stock during earnings. And that's honestly so useful. And let's take Zoom as an example so you can see what I mean. When you type Zoom within the search bar, you're going to arrive on a page like this one. You're going to see the chart, and then you're going to see right under the name of the stock something called EVR. And here you see that the EVR for Zoom is of 6.5. So what does that mean, the EVR? Well, the EVR is basically their scale at OptionSlam so as to classify volatility for stocks. It goes from 0 to 10, and 0 being the stock doesn't move like at all during earnings, and 10 being the most volatile during earnings. So if you have a stock that has an EVR of 10 and you want to sell a short strangle, like just stay away from it, because it means that that stock usually moves like crazy. And that EVR is honestly very useful because now it helps you classify what are the stocks that usually move a lot during earnings and what are the stocks that usually don't move a lot during earnings. So you can basically focus on selling short strangles on stocks that usually don't move too much during earnings. So you really maximize your probabilities of profit here. And trust me, when I did this, when I started looking at that website and I started caring about that EVR and at least the volatility during earnings, I really started noticing some real changes in my results. Because instead of focusing on stocks like Zoom, which as you can see has an EVR of 6.5. And to give you a bit of context, I don't trade stocks for earnings that have EVRs above 2. So note that it goes from 0 to 10, 10 being the most volatile and 0 being the not volatile at all during earnings. I'm not going to trade stocks with an EVR above 2. So I'm really focusing on the stocks that really don't move at all during earnings. And that way, I'm really making sure that the stocks that I'm trading by selling short strangle, I'm really making sure and putting all the odds on my side that I'm going to make money on that trade. So that's exactly what I'm going to do. If I see that the stock tomorrow has its earnings, or let's say, you know, the week after or anything, and I'm just preparing my trades, I'm going to check the stock within OptionSlam, and I'm going to first of all check the EVR. If I see that the EVR is above 2, first of all, it's a no-go for me. After that, it depends on you. If you want to, you can, absolutely. But from experience, I can tell you that you don't want to go trade volatile stocks if you want to trade like this. You want to stay on low volatility stocks because it's just going to make your life easier. So now that we talked about this, now that you understand a bit the strategy and what are some tips and tricks, and honestly, OptionSlam has been like a blessing in terms of that strategy. So just use it, it's free and it's an amazing tool. So now that you understand this, what is it in terms of results? Like what can you expect using that strategy? Well, I've been tracking my trades, my earning trades at least, just my earning trades. Since I think it was end of 2020 that I started doing this. I started looking at that spreadsheet and I started tracking each and every single trade and see basically if it was a winner or a loser for each earning trade. And every time I was selling short strangles on that trade. And basically in the column B, you can see the stock, and then in the column C, you can see the results. So for example, on the second line, you can see that I took a trade on Wells Fargo and it was a winner. Then on IBM, a loser. And here it's important to note that I'm not taking into account, you know, how much money I earned on the trade. It's really not what is important. It's really, is it a winner or is it a loser? That's what I'm really looking at here. And basically what you can see is that I've started to track all of my trades. So you can see that I have like quite some trades. And to give you some overall KPIs, I took in total 42 trades, I think it was, since the end of 2020. I took 42 earning trades. 37 of them were winners and 5 of them were losers, which makes a win rate of 88%. And the nice thing is that as much as when you win, you know, sometimes you're going to make 60% profit, 70% profit, sometimes you're just going to make 10, 20% profit, and that's just how it is. But the good thing is that very often, if you focus on stocks that has low volatility, like I showed you an option slam, then your losers are not going to be that big, because if it moves, it's not going to move as much as, let's say, Zoom would move during earnings. So, you know, it's the nice thing about choosing stocks like this. You might make a bit less money because they have a bit less volatility, but at least you won't get burned. And now we're back in my Testworks platform, and I wanted to show you some trading statements so you can actually see in terms of trades that I've been taking those last days for earnings and what have been my results. So basically what we see is that I sold a short strangle on SCHW, the bank, and I collected $1.01, and you can see that the day after. So you see that I sold my short strangle on the 13th of July at 7 p.m. and know that I'm in the UK, so the stock market closes like 9 p.m. So I literally sold the short strangle 2 hours after. Usually I do this, and then I close my short strangle on C for a very small profit. You see that I made 14 cents of profit. I closed it the next day, 4 minutes after opening, because here the stock market opens at 2:30 p.m. So 4 minutes after opening, I closed my trade. And you see that did the same on Delta American Airlines. I opened it on the 13th of July, and then literally the minute when the market opened, I bought back my short strangle for 50% profit. So you see that I'm basically doing this like almost every day when there are earnings, and you know, I'm used to those low volatility stocks because now I know them, and I'm basically always trading the same stocks, I'm always trading the same strategies, and I'm always doing the same thing. And that just works. Another example of that is, for example, the ticker BK. You see that on the 14th of July, I sold a short strangle collecting 76 cents of credit. And today, 1 minute after opening, I bought back my short strangle for a tiny profit here. But I also did it on Morgan Stanley yesterday, and when I opened it, I did around like 70% profit, so a lot better than BK. So you see that this is basically the profits that I'm getting. I mean, sometimes you make a tiny profit, sometimes you make a bigger profit, but as I said, I'm going to fill that Schwab short strangle that I wanted to fill for the earning trades that is going to happen tomorrow. So Schwab has its earnings tomorrow before market opening on July 16th. So in order to be able to be within the earning announcement, to be within a trade when the earning announcement happens, I need to open a trade before, like tonight, before the market closes, so I can be in within the earning announcement as it happens before the market opening. So if we go into Schwab, as I said, and this was the short strangle that I was looking at, I usually like to stick to the 25 delta in terms of strikes. I feel it's a good balance. I feel it gives me enough probability of profit, and I just feel comfortable. I mean, I don't like to go too close to the stock price because I still want to have like a good probability of profit, but I still want to be close enough so I collect enough credit. So in our case, I'm, for example, looking at the 21 delta, so it would make me collect in total 67 cents of credit, meaning that that would be my max profit. And, you know, hopefully I'm collecting around 60%, 70% max profit, so that would make me some nice trade. And that's something that is really important to know here, is that when you're trading earnings that way, you're not really looking for that big home run at all. Like, you're looking for really tiny wins, and very often, if you win 90% of the time, you don't really mind if you have tiny wins because you're winning 90% of the time. As long as you're staying profitable overall and you're just very mechanical with that strategy as I explained, well, usually it goes fine. And so as I said, I'm going to fill in that order, and I'm going to see if I can actually be filled at 65 cents of credit received. I want to just get filled. So I've chosen the 26 delta on the call side and the 21 delta on the put side. And let's see if it gets filled. So I see that now it got filled, and now when I go into my position, I should be able to see that. So you see that I have a Schwab position now. You see that I have opened my short strangle, and now my trade is open, and basically tomorrow I'm going to know at the market open if I make a profit or not. So stay tuned, and I'll be telling you if I made a profit on that trade or not. I hope it was insightful and you discovered maybe, or you relearned, or you discovered how I was trading earnings. And I hope it was insightful, and I really wanted to be transparent and show you how I do everything, how I choose the expiration, why I choose the closest expiration, why I choose the strikes, how useful is Option Slam. I mean, I think it's an amazing tool, but basically I really wanted to show you everything and show you some examples so everything is clear. But of course, if you have any question, just don't hesitate to comment it below. I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.